Hi, welcome to the Market Alert for Thursday, the 14th of September 2023. So yesterday, CPI surges more than expected in August, the biggest month-on-month since June of 2022. Didn't have much impact on the market though, did it? As we see here, we've got this moving up 3.7, forecast 3.2, so only, the previous was 3.2, forecast was 3.6. So up just slightly on the forecast, but up 0.5% on the previous. But that didn't do a lot for the markets yesterday. And if we have a look at the rest of the news, bonds, big tech bid after soaring CPI, soaring now. Goldilocks, soft landing, or big bad wolf stagflation. Well, we'll just have to wait and see, won't we? Stocks choppy with treasuries firm as hot leaning CPI is looked through. So maybe we'll get the market's reaction on this today. So we'll just have to wait and see. And then finally, a few more weeks of weaker seasonality and then a year-end melt-up. Will they front-run it? Well, we always get the Santa rally, don't we? Well, not every year. I've seen a year where we didn't. I can't remember which year it was, but it's very rare. But in order to do that, we need some sort of a shakeout first, and we still have this in place with the implied volatility. Yesterday we dropped down to 10.27. The low we've had is 10.01. So we're getting back into the realms. We are in the realms of the market being in a corrective phase. We went through this a few weeks ago, but it didn't continue, as we can see there. So no reason why this can't be so. So medium term, again, similar picture. And then in the longer term, we can see we're still down in these lows over here. And we also spoke about this last week with the calm before the storm. So yeah, this time last year, we had the calm before the storm. It was led by Liz Truss and the increase in, following a budget when the market was really concerned about the gilts or the interest rates on the gilts, and this would cause a massive problem for the pension companies, etc. It was complete BS because those rates are actually higher now than they were this time last year. Nobody's making a fuss. It was a way of just engineering and shoehorning in Sunak because they didn't want, the World Economic Forum, let's state it as it is, didn't want Truss. They wanted Sunak, their man, because his father-in-law actually owns the company that's going to produce the digital IDs for all of us. So I'm not going to go down the conspiracy theory thing in this alert, but I just thought I'd lob that one in for you. And that's why that was engineered by selling 75 million worth of pound futures, which are derivatives, gambling instruments, easy to do, doesn't affect anything apart from what you want it to affect, i.e. in this case, plunge the pound, get rid of Liz, bring in your man, job accomplished or mission accomplished. And like I say, those gilt rates are higher now than they were this time last year when all of the furore was going on. So sometimes you just have to peel away the layers, have a look, see what's really going on. So we're in that same situation where we need a bit of a storm, a good shakeout, bring the implied volatility up 100%. And in fact, let me just go back to October of last year. I should still have this on the chart. There you go. It's there from 1472 to 31, 100% increase. Market stops on the decline, and we then see the market move higher. So that's what we're looking for. We've got the catalyst, as it were. We've got the low volatility. We need 100% increase. We get the bottom. You buy the stocks for the Santa rally. So there we go. Right, let's move on and have a look at the markets, and we'll kick off with the Dow. So in the Dow yesterday, moving slightly lower. Overnight, it's a bit higher. You can see that, but we're still in this sideways range. We need a good shakeout to the downside to get this market woken up again. Yesterday, we moved up with the CPI numbers, and then it's interesting. You just got this cascading effect all the way down to Tuesday's low. The market up on the overnight above the DP at the moment, and will it get to the high? That's the question. Well, the one market that was heading to the high when I looked earlier was the German DAX, so let's have a look at this one. So German DAX daily chart, market starting to move up, as I've said. Needs to get through the 200 MA, the 20 and the 50 EMA. there as well. Let's just make this a bit bigger and move it over so we can see what's going on there. If I get rid of that, it should move up a bit more. There we go. And let's just remove that for a moment. So there you can see what we've got. We've got the 5, the 200, the 20 and the 50, and we need to get through these in order to move higher. In the 30-minute charts, like I say, we're already heading towards the high, which is just tucked away there for yesterday, and the 200 MA is in the way in the R1 as well. But going back to yesterday, the market up to the 200 MA, then all the way down to the S2, then back up to the low, and then back down to the S2 following the US in the afternoon session there. In the S&P, we're also sideways to higher there. You can see that we're heading, well actually we're above yesterday's high in the S&P by the looks of things. So look at the 30-minute, we're just there now. So it's moved up overnight nice and steady. It makes you wonder whether the market's going to actually digest the CPI numbers yesterday and move down today and say, actually, this isn't that good because it's increased by 0.5%. And as the headline said, it's the highest month-on-month increase since June of 22. So who knows? And, well, it would be the first time I've seen that happen either, where they've moved the market up and said, okay, this is fine, keep it moving up, and then the next day the whole thing tanks. So I'm not saying it's going to, but it is an option. It's always an option. They may just discount it and move the market to the upside, who knows? But you've got to have an open mind about this and sort of think about the options that could be. So again, bit of a lackluster, but overnight, nice trend to the upside, as you can see there. In the FT100, we're also above yesterday's high. Europe, particularly the DAX and the FT100, ignoring the CPI numbers, as you can see there. So above the high already. Yesterday was a bit choppy. The low became very important yesterday for this market, and then trading up to towards the high, pulling back, but nowhere near like the Dow did or the DAX, and then moving up, like I say, nice and strongly overnight. So the US dollar moving up yesterday, down slightly overnight, but I suspect this is going to move higher as the prospect of higher rates continues. So let's have a look at the impact on the metals yesterday. As I said, we haven't finished on the downside with the metals. If there is a prospect of rates continue to increase even by 25 basis points, the metals are still going to be monkey hammered. Like I say, they haven't finished with hammering this yet. We're going down to $20, as I've said before, on this market, because that's where they want it. So there, we're already down to 22.82. And in the 30-minute chart, there's the reaction to the CPI, there's the overnight, and this is probably the similar thing we're going to see with the stock market. So yesterday they were fine about it, and now all of a sudden we're not fine, so they're selling into the metals. Same with gold, you can see they're heading towards that 78% retracement, 30-minute also, but it's not moving down as fast as the silver market. If you look at the 30-minute silver, we've already taken out the low. In the gold market, 30 minutes, we're not anywhere near it. So that means only one thing, that the gold-silver ratio is going to be moving to the upside. And there you see it. As I've said before, we're going up to way beyond 90. And if we bring this in, you'll see why I'm saying this, because this is where it's likely to go to this time. It's got to take out the resistance at 86, but that will be a piece of cake. You can see exactly what they're up to. And also, when you have the shakeouts in the market, stock markets, if we get one based upon the implied volatility being lower, then silver will go down. It always does, because the stock market going down always looks like there's a recession coming. That's a bit of a joke, isn't it? I mean, as far as we just changed the way the data's calculated so that we're not in a recession yet, but there are strong key pointers that we could be or are. So again, it's all about massaging the figures, isn't it? Nothing's the truth anymore. You have to try and figure out what's going on, because it's all a pack of lies, and designed to be so, just to keep you thinking that everything is fine when behind the scenes it's not. So there we go. That's where we are. and let's see what happens during today. See if the market does abreact to the CPI numbers from yesterday and we get a down move. So we'll just have to wait and see. But this is an interesting channel, isn't it, that's developing there, and I suspect unfortunately it's going to break out to the upside. Okay, that's it for this one. As ever, thanks for watching. See you in the next